the massive bottleneck to success with an AI company and adoption by customers is 10% product, 90% change management.
Well, hello, Soundbites viewers. My name is Bill Bench with Battery Ventures. I'm the host of Soundbites, the battery podcast for all things go-to-market. And welcome to 2026. This is our inaugural kickoff episode of the year. And I'm always excited by our guests, but this one, the word legend gets thrown around pretty loosely in this world.
Oh, geez, Bill.
I gotta go there. But this one, this guy's the El Jefe of sales, if you know what I mean. So I want to give a big warm welcome to Mark Roberge of Stage 2 Capital. Hello, Mark.
Oh, Bill, thank you. Always an honor to get together with you. We always talk, like we've been on a couple together. I don't remember where we met. It was probably some like small marketing conference in 2007 or 8 where no one had ever heard of Marketo or HubSpot. And, over the years, I remember calls where we would jump on the last day of the quarter and just chat. Like we couldn't say too much, but we kept it, we were friendly, and it was just like, I think that's where the relationship spawned from.
I do too. I remember a Salesforce Dreamforce conference in San Francisco, and we met at that St. Regis Hotel, which is right across for breakfast.
Yes. Right.
And I remember it was epic for two reasons. One, it was the kind of, I would say, probably the crystallizing of our relationship. But I also remember Richard Branson walking by while we were in so kind of a random memory.
But, oh my gosh, that's right. That's crazy.
But agreed, those early days of the marketing automation and building that segment of the market out were just amazing. I loved going to those conferences. I remember as we'd be packing up our booths, like a bunch of the heads of sales would look over and be like, hey, let's let our teams do this. You guys want to go grab a beer? And like you said, we'd go and talk and trade stuff, but can't trade too much intellectual property. Right. But like I also kind of like, oh man, you guys beat us on that deal and we were super bummed. What'd you do to win it? That type of stuff.
I hope people out there, like, this was 20 years ago almost. So I hope those of you who are in that seat for the first time, like the people you're competing with can become lifelong friends, and, just put it in perspective and, have that relationship with them, because it's been awesome for us.
It is. And look, if you're in this business, likely you're going to be in it for a while. And so those relationships are really valuable down the line. People that you stood across the street from sometimes come to the same side of the street or standing shoulder to shoulder with you after that.
And now we're sitting on a board together doing deals. So that's where it ends up.
That's exactly right. So let me do a quick highlight reel just for all the viewers that may not be familiar with you, Mark, but you were the HubSpot CRO, the founding CRO at that organization, and saw them through their IPO and through a lot of their early success. You're the founder of Stage 2 Capital, a venture investment firm. You're an active lecturer at Harvard, MIT, and many other school and educational institutions. And you're the author of 2 books, the original book, The Sales Acceleration Formula, and now coming out, I believe, in a week from now, The Science of Scaling.
Correct. Thank you.
Yeah, so we'll spend a lot of time talking about The Science of Scaling. Thank you for sharing a pre-read of it with me so that I could get a little bit further into your head. I think my quick comment on this is the word science of scaling is the really operative word of this book. But before we dive in to the new book and the framework that you've built around that, let me, Mark, ask you a question after I've asked ChatGPT a question. I had to go.
Beautiful.
Do this. I asked ChatGPT to tell me what I should know about you, since I'm going to host you on a podcast. And it came back with 5 words that I think were really interesting, and I want to get your read.
So, hey, early reps on the call or leaders, if you haven't already figured this out, replicate this to prepare for discovery calls. Like, it's these little stupid nuggets, right? Of like, okay, what are you going to ask on the discovery call? Ask it in ChatGPT. It'll help you prepare. And even like Dimitri at Perplexity, who's the chief business officer, he asks it on the call with the prospect. Like, what should we be talking about? Which is like, there's all these like cool little tricks, and kudos to Bill for giving us our first one here.
Well, look, thanks for adding color to that whole thing.
Yeah,
I do think that's a best practice. I spend a lot of time with students advising and mentoring them, and I talk about all the things I do to prep before a sales call, and seeing that these are students that are pursuing a degree so they can go get a job in sales and or marketing. I talk about that in getting a job, you need to do those same things. So you just called it out, which is, go and use every resource that's available to you. And obviously AI is a great evener of knowledge.
totally.
All right, so 5 words. Let's see if it does you justice.
Oh my
Deeply
gosh.
practical and theoretically sharp.
Ooh, I'm buying it. I like it a
Okay.
lot because I think like I probably do walk that line okay. I think you have like a lot of the folks on one of the spectrum where they have been extraordinarily successful. Maybe they did two huge companies that became like historic generational companies, but unfortunately, it's very difficult. I mean, and for anyone to be able to like get out of that deep context and be abstract. You know, they say things and some of it hits and some of it doesn't, and some of it's super unique. And then like there's people who are way on the other theoretical side. They've written all these books. They, have a fancy like, doctorate or like professorship, but they've never operated. They've never
Right.
practiced. So I do like that, Bill. That's a cool, unique way to drive it in.
Look, I liked it because so theoretically sharp. I think, anybody that's as active with educational institutions, you're probably going to talk about some theory. But then I like the practical balance because it says you are that operator who's going to come give the tactical. You can step down from the strategic high level part of the mountain and come down the mountain and bring that. Not to mention, I mean, you have written a couple books. One of them has the word science in it. So to me, it tells me that it does justice. It says that you're a data driven type of person. You're going to have a formula or a framework of how you operate. So I liked it.
Yeah,
I thought it
thank
was
you.
pretty
And
good.
it's like it's weird. Sometimes I put this slide up in speeches where I've got this accidental flywheel that has evolved in my current career to all the things you pointed out today, which, as the name senior lecturer at Harvard is basically adjunct professor. I was full time for some time. I have an office, an assistant, I'm on benefits there, like all that kind of stuff. I primarily do venture capitaling these days because like that's a very intense job, but I still maintain my professorship there, but it's just such an opportunity to like, I don't know where the loop starts, but it's basically like, okay, you're in a boardroom and you see something, and then you're in the next boardroom and you see something and you're working with a founder, and now you're just wondering, is it a pattern? So then you bring it into the classroom, and now you have 90 students from all walks of life, from Europe, Asia, South America, North America, from industrials, from manufacturing, from finance, from healthcare, from tech, banging on these things, making it rigorous. Then you go out and give a speech at SaaStr or whatever about it. Maybe you put it out on a blog article, and then you bring it back into the boardroom as like rigorously pounded on research and best practices. So there's this like, to your point, there's this like kind of blessed, cool little like flywheel I've got going on that naturally goes every day between the practitioner to the rigor and abstraction of the theoretical design that comes out of academia.
But think about what you just said there, Mark. Like all of those data inputs, you're talking about boards. So those are practical real world companies. You're talking about students. These are people that are out practicing and coming from all different backgrounds of life and sharing different thoughts, challenging those things. Then you're going out to the speaking circuit and putting it out there, and people are giving you feedback and like thanks for like, hey, that's something I didn't know. And then, like you said, it's like it's a really, really good circle of life because then you just go back and you continue on that learning cycle.
Yeah,
Good
exactly.
stuff. Good stuff. Okay,
Thanks.
so I promise that the book is our main stage
Yeah, all good. All good.
for
Talk about
for today.
whatever.
But let me ask you a couple questions to get us warmed up here. So you just returned from a Bay Area meeting where you met with a bunch of AI focused CXOs, executives spanning all functions. If you had to share with the audience here any top 2 or 3 takeaways that you
Oh
you
my
came away
gosh.
from.
I'll have an article about it, promise, in the next 3 weeks because I always do this. So yeah, just to zoom out for a second, in my part-time post now at Harvard Business School, I teach two classes. One is the founder sales class, which I'm proud to say has become like one of the most popular classes on campus. I co-teach it with Lou Shipley, who we started 5 years ago or so with a 90 student class. It was oversubscribed, so we added a second one, oversubscribed. We had a third one, oversubscribed. We added a fourth one, oversubscribed. There's only 900 students in each class, and we offer it to 360, and we still have a wait list. So we're now at a fifth one, and it just speaks to like the cool interest of the student body these days to like appreciate, like wanting to do startups and appreciate sales. The other class is what Bill's referencing is every year in January I do a field trip class. It's 4 credit to Silicon Valley. There's 10 field trip classes. One goes to South Africa, one goes to Beijing, one goes to Madrid, like one goes to Sao Paulo, blah, blah, blah. I do the domestic one to Silicon Valley. And because probably 40% of our students are not from the US, some of them have never been to Silicon Valley before. So it is such, to watch them get into their first Waymo is like the coolest thing ever. And obviously, like, bringing 50 students there from a place like Harvard gets you in the door at a lot of cool places. We meet with the president of NVIDIA, the C-level executives at OpenAI, the CEO of Figma, the CEO of HubSpot. We've met the CEO of LinkedIn in the past. I mean, this year, and we did Perplexity, we did Tesla this year, we did Waymo this year. Gosh, your question. You can see what I wrote about last year because I always publish something around late January, February, because I write all these notes when I have these like closed door sessions with these execs. And then it's the whole class is quite self-serving, even though I think the students like it. A week later, they each owe me a 2-page paper called Perspectives on AI. And I always tell them, don't go broad, like, oh, here's what we learned on the trip. Like, pick a subject and go deep. Like, I forget what one of my students talked about, like, I think they're like going to take over their government back in their village in Africa. And like they were, cause like they're kind of like the heir to it, So it's like, it's so cool to like hear these things. So let me try to like, and I use that, I take all these notes and I'm trying to like, FOMO is at an all-time high, like ever in tech. Like it's a gold rush out there. And 996 is a joke. People are doing more than that. I think temporarily that's okay. I think in the long run, I'm a little worried about society and them. I'm more convinced there's a bubble than I was going in, especially in the application layer. I think like there's a couple, like I think the general meme is a little off in a couple places. I think a lot of founders believe that their moat is working hard. And I just don't think that's super defensible. I think other people are really hyper focused on creating a moat through distribution. That's like a meme that's going around. I think it's come from like some of the early massive scalers of AI that basically exploited old school PLG. And they're kind of confusing that that's applicable to every context. And I would say one trend that I love is if I had to choose between two AI companies, one AI company has an A+ product, but a B- professional service implementation team. And the other team had a B- product with an A+ professional service implementation team, otherwise known today as the forward deployed engineer. I would choose the latter. I think that the massive bottleneck to success with an AI company and adoption by customers is 10% product, 90% change management. And because we, as investors and boards and entrepreneurs, have been like very hesitant and concerned about services revenue, I think that misleads us at times. And right now is a time to like triple invest in the implementation to make this stuff successful. You see some early winners around that. So anyway, like I that's kind of like throw up of random thoughts, Bill. And I will promise the audience that maybe even likely by the time this goes live, if you want to check my LinkedIn feed, you will see a much more organized orchestration of observations from the trip.
All right. So a couple observations on
Nice.
your observations. There's 6 or 7 like wonderful nuggets that we could plow into. I'm gonna hesitate to do that today because, like I said, I do want to get to talking about the book. But just what those rolled off the tongue, those were all absolutely fascinating conversations that are happening out there. So thank you for sharing. And everybody listening, you heard Mark just do something really smart, and I'm going to reinforce it, which is if you're watching this and you're not linked in with Mark, you don't follow him, his content's absolutely exceptional. The way that we learn is through each other. To think that you're just going to live inside, there's the forest and the tree. And as we know that as a leader of an organization, we are right up against the bark of the tree that we live in every day. The way we learn is through this. And as Mark said on his first nugget there about it's a gold rush out there, it's also an incredible learning time. And I say this
Totally.
all the time. I feel really fortunate that I started my career right as the internet was coming into the business world. And I got to go through that whole change and watch the software world go from on-prem to become in the cloud. I got to watch mobile come and take over. I got to watch all of these like seismic sea change things happen, and just watching the motion that AI is out there. I say this all the time. I don't want to be the SaaS guy living in an AI world. So that's why the stuff that Mark's sharing, the stuff that anybody that you can get out there that's on the front edge. You heard Mark talk about his cycle of how he's learning. He's in classrooms, he's in boardrooms, he's out in the field, he's out at speaking events, he's meeting with all of you. And that's how we're going to continue to grow and develop through this
Well said.
process.
Well said.
So a plug to follow Mark. Okay. Thank you for sharing the feedback. I didn't know that you had done that trip with students. So that was even more interesting. Let me ask you another question, and then we'll dive into the book here. A very common question, Mark, that I get asked, I see it out there online, is I'm a $1 million ARR company. I'm the founder. And to date, it's been all founder-led sales. Me and the other co-founders have done all of the deals. Do I hire a sales rep or do I hire a sales leader? This is the chicken or the egg question.
Totally.
Like, do I hire a sales
Totally.
rep or a sales leader if I'm going to start doing that transition away from founder-led sales?
Yeah, that particular question, a very interesting one. And a lot of it's driven by your capitalization context. So we can play both sides of them. On one hand, I kind of like, ideally at the minimum, I want to hire 2 reps. If I'm just going to go the dip my toe in a little bit, just because like if we hire one and it doesn't work, we don't have a lot of certainty. Was it the bad hire, or is there something wrong with our go-to-market or business model? But if I hire 2, I at least give my shot a chance at some variance, where if they both don't work out, then it's slightly higher probability that I've got something macro going on with my business context. Versus if like both work out, hey, that's awesome. If one works out and one doesn't, then that's good news too. Not so good for the person that's not working out, but
Right.
at least we know like we can make one person productive. We could probably find more. So I probably, if I can afford it, I'd love to try to go to 2, and that would be my slowest crawl. And then the other aspect is you go leader right out of the gate. Now you have an opportunity for them probably to do a little selling themselves, but like you're probably going to have them start out of the gate, maybe the first quarter with between 2, 3, 4 hires, and then put them on a pacing of like, let's just hire maybe 2 more a quarter, something like that. Like it could be 2 a month, it could be 1 a quarter, like whatever, but we're going to establish a pacing. And that's nice because as a founder, I'm assuming you might not have that much experience building a go-to-market team. You might have never hired a salesperson before. You probably have never designed a professional sales process before. And you have an opportunity to go hire someone that has done that. And believe it or not, a lot of good reps have never done that. They've never hired a rep. They've never built the sales process. So you're setting yourselves up with an advantage, but it comes with a cost. Like, let's just make up some numbers. Your first sales leader costs $300K. They're going to go hire like 3 reps in the first quarter. They're each going to be $150K each. They have to ramp. You might not see any revenue from them for 1 or 2 quarters. So like the dollars start to add up. So it really does come back to like how well you're capitalized. You lived through it as well, Bill. Do you have Bill? You lived through this too. Like, what's your take?
I'll first react and then give you my take.
Yeah,
Let me
please.
do it combined. First of all, like I'll summarize what you said. The first answer was redundancy. Can I hire two? And
Yeah.
I'm a big believer of this for the exact reason you said there is number one, if something fails in one of the profiles I hired, then someone's there to pick it up and I don't go back to zero, which is actually more than back to zero. It's taking me backwards because I now have to go through that whole hiring and onboarding process. But two is I think two people, when they come in together as a class of, when you as the founder hang up the phone with them, they called each other and they learn from each other. So they elevate um, up, especially inside of a small company. So my answer on if you're hiring sales reps first is absolutely, and it is capital constrained, but try and hire two sales reps at the same time. And in fact, any role, if you can afford it, to hire in multiples. And I think you really hit the core thought on hiring a manager first is that a lot of the founders that I work with come from a technical background. And
Yeah.
so their skill set inside of sales or marketing is limited. And so from that perspective, hiring a sales rep, they're going to come in and they're probably mostly going to mimic the type of sales cycle that you've created of how you qualify, of how you demo, how you convey value to your customer. Whereas typically when you hire somebody that's maybe a little further up in their career from a seniority perspective, a manager, they're coming in, they've probably seen sales methodologies, they've learned how to tie a business problem to a technical product and know how to convey and articulate that value. And they're going to start thinking about those things. And then, like you said, they're going to go down the hiring road. So um, I don't have a one size fits all answer for that question. I typically ask, like a good salesperson should do, a bunch of qualifying questions of the founder who's asking me to learn some of the things that you just called out there, which is what is their background in and what their skill set is, how much money, how much financing have they taken, what does their growth look like today, how many customers do they have, are those customers happy, things like that.
Totally.
All right. That was a great warm-up act. Mark, let's get to the headliner though here. So the Science of Scaling is your new book, comes out February 3rd, which probably by the time this is published will be a week or so past. So we have the book coming out. As I mentioned earlier in this podcast, the word science is very clear in the title of this book. It's about applying frameworks to how you grow and scale your organization. And in it, Mark, you call out three stages. Your framework calls out three stages, which there is classic product market fit, there's next go to market fit, and then there's growth and moat. Do you want to give us a
Yes, you got it.
flyover on a little bit of that framework that you built?
Yeah, that'd be great. Yeah, and I'll give a little bit of context on how it came about even writing the book, which helps feed that. As also, like I never intended to write either books. Like they just these
They
things just
found
kind of.
you.
And I'd encourage folks who like if you ever write a book, create the foundation that may or may not lead to actually publishing a book. And so let me explain that. For the first book, that started with in 2011. I think I sat down for breakfast with Jill Conrath, who Bill and I know as like a world class author of many books during our time, and she's most recently came out with another one. And she was just like, heard my story and was like, we should write a book together. And I was like, Jill, I barely broke 500 on my verbal SATs. I don't know what you think you're getting into. But she was like, yeah, let's come on, let's do it. And I wrote a chapter and she's like, this has to be your own book. So that's what led to the first one. Was I just kept getting calls from all these people. Have they heard of scaling HubSpot? I'm like, how do you hire a rep and how do you do a forecast and how do you, and it just like, it was very easy to write that book because it was just like an amalgamation of 2 years of calls to and from work with these founders and early people and the answers that were working for them. And a similar thing happened here is after the HubSpot IPO, I needed a break from operating for a little bit. That's when I was recruited into Harvard Business School full-time to join as a professor and build the sales curriculum, which also gave me a lot of time to do what Bill and I do almost full-time now, which was to like sit on some boards, do some angel investing, advise some companies. So for 5 years, I did the teaching and I did that on my own. A lot of the stuff came from like the people that backed HubSpot. So Sequoia and General Catalyst, they'd be like, hey, Mark, we just did this like series A or C, like, would you help them build their sales org? And so I didn't want to be that guy that was pulled in a million directions. So I picked one company a quarter to do a day a week with. So that gave me the time to be able to like listen to calls and do interviews with them of reps and like what's their sales process and really get into the nitty gritty. And so I did it with like probably 15 companies over those 4 years. One went public, two exited $1 billion, two more were valued $1 billion, bunch of bankruptcies. Like that's just the game that we play. And it was a cool time to reflect on all those patterns between my students and that work of like what caused that $1 billion outcome versus bankruptcy. And so many of those reflections came back to like when they decided to scale revenue and how fast. And I could kind of like go back to that moment in the board meeting and be like, how did they decide that? And it was like kind of embarrassing how they were deciding that. It was sort of like, I don't know, like when we got the money for it with not much like analysis of whether they were ready to scale. Or it was like when we had product market fit, but then you asked them what their product market fit was. And there was like this, you just know it when you have it, like, and like the pacing was very much like, I don't know, like they told us we had to triple, double. So we just took the target divided by the reps quota and hired 20 reps the next week. Like when we had one rep on the team. I mean, like, so, like, and Bill, you and I laugh at how absurd it is, but people are still doing this. And so like, so basically I was like, okay, I should do a speech on this. And like most years, like Jason Lemkin invites me out to SaaStr, and I always try to use that invitation to like do some like annual new content. So in 2019, I did a speech on this called The Science of Scaling. And I've done a bunch of other things from like AI to like SaaS best practices. It's just, this one just took off. It was like, I think for a long time, it was like the number one watched SaaStr speech on YouTube. And people kept saying, can you do another speech on that? Can you do another? Can you write a blog on that? And then Jay Poe was like, hey, should we start a VC firm? Part of which the uniqueness would be built on this methodology. And then, it just kept going viral. I started writing cases on it, teaching on it, speaking on it. And then last summer, Stanford University, or 2 summers ago, was like, can you write this up, publish it? And, Wiley, my original publisher, called Rights of First Refusal. But like, bottom line is like, never intended to write a book. But sometimes you stumble across a piece of content that seems timeless and seems like it's very applicable, whether you're selling software in Silicon Valley, tractors in Sao Paulo, or pharmaceuticals in Japan. And that's what happened here. And so that led to the book. And never mind the fact that I'm very passionate about mental health these days, and I've always donated the proceeds of my books. And this one is all going to mental health, which it was so motivating to get up every day and work on this content and try to make it great. So that's the backstory in the book. And hopefully it gives you some context on what we're trying to solve. And so to Bill's point, the first riddle is, when are you ready to scale? And I propose two sequential milestones, which on the surface are like, duh, but let's dig into it. The first is product market fit, and then you have to have go-to-market fit. So I like to separate those. And like qualitatively speaking, I discuss product market fit because when you ask students or tech entrepreneurs, like, when are you ready to scale? Product market fit is a common answer. Good answer. Invented by Eric Ries, arguably, in Lean Startup 20 years ago. Then you go around and say, okay, you 100 founders who said you're going to scale when you have product market fit. What is product market fit? That's when it gets interesting. Read the Wikipedia page. It's a feeling. You just know when you have it. It's like, ugh, that's uncomfortable. And some of them will say, oh, it's when you have $1 million in revenue. It's when you have 20 customers. Right. It's like when you have a lot of inbound demand. In my opinion, Ron. Like, that's just market message fit. Bill and I can sell ice to Eskimos if you want. Do they need ice? No, but we can do it. But like, so in my opinion, product market fit is when you consistently create the value you intended for your customers.
Right.
When your customers buy your stuff and see the value you promised them.
And Mark, one of the things that I liked, I assume you're going here, is you separate lagging indicators, which is the next part of this, which is, I think a lot of companies do look at the output of what they've done to make this decision. as opposed to looking the leading side to see if there's repeatability. So I assume you're taking us there.
Totally. We're right now we're in when are we ready to scale? And I'm saying it's when you have product market fit, then go to market fit. We're talking about product market fit. We've established that product market fit is less about acquiring customers and revenue and much more about value creation. And in the world that we all live in, Bill, and many of the folks listening, the absolute best way to quantify that is retention. That basically means that someone has bought your product and they rebuy it and buy more. That's like the best quantifiable measure. But to Bill's point, in startup timeframes, we don't have the time to wait. Like we really, if your team goes out and acquires a bunch of customers this quarter, you don't know what the retention on those new customers are for maybe a year. We don't have that time, right? So yes, retention is the best quantifiable metric of product market fit in our world. It is a lagging indicator to Bill's point. And in startup world, it is critical that we define what I call the leading indicator of retention. And what that is when you sign up a bunch of customers this month or this quarter, what can you observe within their behavior or implementation or outcomes from your product in the first month that if they achieve that they will probably be with you forever. They will renew, they will expand, and they'll be a great LTV customer. So, and I go further in the book to frame it for people. I'll say your LIR, your lead indicator of retention, is P% of customers do E-event every T time. 3 variables, P, E, and T. So Slack, 80% of customers send 2,000 T messages every month. HubSpot, 80% of customers use 3 or more features in the platform every month. Dropbox, 80% of customers have their device backed up every day. Right? These are bringing to life. And like, imagine the founder of Slack in the early phases being like, our first North Star is to get to $1 million in revenue. Imagine what happens, the actions, the execution, the results, versus our first North Star is to get 80% of our customers to send 2,000 team messages every month in our platform. Gosh, we'd much rather invest in that latter company, right? So hopefully that gives us a quantifiable view of what we mean by product market fit, rooted in the right spot, and systematized with lead indicators.
I love the definitional aspect of this. I love the leading element of it. I love the measurable pieces of this. This is gold for anybody that's on the founding or entrepreneurial side listening to this podcast. This is absolute gold on thinking about how you think about that first thing, which everybody does talk about PMF. Everybody used to talk about $1 million of sales was the old definition. That's totally gone away right now. So this is absolute gold.
And Bill, just to like for you and I to like scratch our itch here, if you're seed or pre-seed, can this just be your first chart in the board deck, please? Like I get it. It's great that you achieved the revenue target. I love it. That's meaningful. But I'm more worried about if the customers are seeing value, right? And it's crazy how many companies at that stage have a polished income statement and can report to me how much they paid for printer ink in the last quarter. But they cannot tell me how many of their customers use their product every week.
Right.
That is crazy.
Right. This is, look, let's add this to the list of nuggets or of takeaways from this call today is the being able to look at the leading indicator side. Mark, so we're on like of the framework of science of scaling, we're on the first piece, product market fit.
Yeah, product market fit. So we've got that established. Okay. So now we've checked that off. We've defined our LIR, lead indicator retention. 80% of our customers are sending 2,000 team messages every month or whatever our implementation of that is. And we can talk more about how to define those. And it's like we can rave the success flag for product market fit. Okay. So basically qualitatively proven that if we're going to go sign up another 20 customers this quarter, that most of them will see the value that we promised them and be happy. Now, go to market fit means we do that profitably. right? So like I don't recommend you do that during the product market fit phase. Like the great Paul Graham, founder of Y Combinator, says, do unscalable things early. You should be like flying out to customers that are paying you $50 a month to onboard them, make them successful. You should be generating like leads through your VC network. Like you should not be pricing this thing for profitability early on. Who cares? Give them 50% discounts. Unless your entire value prop is around pricing, just get people into the software, committed, using it. And once we've proven that, now we have to make sure we can do it profitably before we add 20 reps. And when I say profitably, I'm not talking about GAAP accounting profitability that takes into account your office and your like all the stuff that's not going to scale with revenue. I'm going to isolate it to the costs that grow with revenue. And that's largely talked about in our industry as unit economics. So I need good unit economics. That's what we mean by go-to-market fit. All right. So pick your poison there. A lot of people talk about payback period. You can Google that if you don't know about it or ChatGPT it. Some people talk about the magic number. Some people talk about burn ratios. Some people talk about LTV to CAC. Do all four. That's great. But it's just we need to understand that we are acquiring customers in a profitable manner before we add 20 reps and pour like tens of millions of dollars on top of this. And so now let's just say we're going to rally around payback period of 12 months or less. Right. So the cool thing about that is hypothetically speaking, when an account executive joins your company and they're like, what's my job? The best answer is not to achieve a certain quota or achieve a certain ACV. It's actually to achieve a unit economic goal. Let's say payback period less than 12 months. If you tell that to a 27-year-old account executive, their head would explode.
Right.
They'd be so confused. And that's why we have to algebraically extract that formula back to things that we can conceptualize, like quotas, close rates, cost per lead, how much we're paying our reps, et cetera. And so in the book, I just do that. And that's a little easier to conceptualize. And now we have a go-to-market model that we can then go out and try to achieve. And we can dashboard it. And as long as our outputs are staying above the business model line, then we can call success on go-to-market fit. So now we have product market fit, which means that we are going to sign up a bunch of customers and they will see the value we promised them. And we have go-to-market fit, which means that we can acquire those customers and serve them in a profitable way and create a profitable business model. And now we're ready to move into growth. And I will just say that I strongly recommend you do product market fit first before you do go-to-market fit, because you dramatically run the risk that you will optimize your go-to-market on the wrong product market combination. Focus on product market fit first. Hopefully you get it in a week. I don't know if it's going to take a week, a month, a quarter, or 2 years. Who knows? But get that nailed and then optimize the go-to-market on your outcomes. And then you can move into the growth phase.
Well, I love how you start this go-to-market fit section with like the age-old adage that the company wants to hyper grow. They hire the sage, battle-scarred sales vet who comes in armed with
find that CRO that's gone to an IPO. Get that person.
That guy or gal is the one, because they're going to come in here with their playbook, their people. They're going to build the model, the methodology. And then what happens? They come in and they whiff, right? Like what could have gone wrong with this model?
How many X Oracle or I don't pick X Oracle, X Salesforce, X whatever, pick your poison, have we cleaned up where they came in after running a 2,000 person team at a 20-year-old company and come into a $4 million revenue company with 3 reps and set up 27 territories. And like, it's just not the right fit.
Last summer I hosted a CRO summit of Battery, and I got some data from Carta, and what they said was that the average CRO tenure right now is 22 months. And I thought that was interesting. I walked around the whole Battery general partner team, who most of them have been here 15 years, some of them 25 years, and 9 folks. And I just asked, when you have a new CRO, new sales leader come into your organization, what's the number one reason that you see they fail? And their answer was pretty consistent across the board. They said they bring their old playbook in and don't adjust for the ICP, for the sales type, or even the culture of the new org. and the org experiences like a rejection of that
Yes.
person. And so I really like going through this section. I also really enjoyed, Mark, that you again defined another metric. And this is where I said measurable is really important, of the leading indicator of unit economics. So in the go-to-market section, you had the leading indicator of retention. I loved the definitional element of this. This is where I think, like, going back to the backstory of how you wrote the book, that this could be a textbook, this could be a course, this could be a framework for how companies help build their whole like product to go to market transition. But I love the second part here. You brought in yet another and defined yet another concept, which was the leading indicator of unit economics.
Right. And just to capstone that, to give people an example that Bill said, let's say the output of the unit economics is the payback period. Well, that is how much it costs for you to acquire the customer divided by how much they pay you. So that's CAC divided by ACV. CAC, ultimately, when you extract this back algebraically, is going to be a function of what is the quota you're assigning your reps, how much are you paying your reps, what's the ACV of your customers are going to buy, what's the close rate of the leads, how much does it cost to be a lead. These are things we track. We just don't probably put it together systematically to like know that this is the output that proves that. That's what he means by the lead indicator of unit economics.
This is great. So nice segue into the third portion of the framework of the science of scaling, which is the growth and the moat,
Yes.
using
Yes.
quantifiable milestones. So getting back to
Yes.
metrics and tracking.
Right. So now it's like we've answered the first question. It was like, when are we ready to scale? We're ready to scale when we have product market fit and go to market fit. We're going to measure those using lead indicators so we know 3 quarters ahead of our peers if we have them and if they break. Because by the way, if you're a $2 billion business, you're still going to measure these because you'll probably lose them and you'll know. And we're going to tackle those sequentially. First product market fit, then go to market fit. Then we're ready. Now how fast? And we both lived in these board meetings. I remember looking at evaluating this company. What's your plan this year? We're going to go from 2 million to 12 million. Wow. That's fast. How are you going to do it? Well, we hired 20 reps last month. Huh. How many reps do you have before? 1. Oh, God. What's wrong? You're going to be firing 20 reps in 6 months. That's literally the answer. Well, we just took the output, divided by the quotas, figured out how many reps we needed and hired them in January. Now we're going to cross our fingers. Do you know how many candidates you need to generate to hire 20 good reps? Do you know how many screens, interviews, role plays? Do you have a methodology that you can ramp them with? Did you know that the average rep to manager ratio in the industry was 8-1? Now you need 2 managers. Do you have those? Do you know that like 80% of your demand last year came through events and VC introductions that will not scale? Just like the list goes on. And so the first like very simple framing or reframing that I make on that is like, don't lump sum hire a bunch of reps at the beginning of a fiscal year or after a fundraise. Establish a pace. Don't do 20 reps in January. Do 2 reps a quarter. And then like we can figure out if we're going too fast or too slow. So, and I don't care if it's 2 reps a quarter, 2 reps a month, 2 reps a year. I don't care. Like pick your pace, but start with a pace. Let's just say 2 reps a quarter. Let's hire 2 reps a quarter. And then let's watch it unfold for 2 quarters. And what's cool as to whether we know if we're going too fast or too slow is our leading indicator of retention, measurement of product market fit, and our leading indicator of unit economics, measure of go-to-market fit, is our speedometer. If those stay green, then let's go faster. Let's go to 4 a quarter. And if they go red, diagnose, fix, hopefully in a week, 2 weeks, and get back on track. And if it stays green, you go to 4 a quarter. And if it stays green after 6 months, you go to 8 a quarter. And if it stays green after 6 months, you go to 16 a quarter. And congrats, you're a unicorn. And you did it in a very systematic way. So that's basically it, Bill. It's like, don't do this lump sum that 99% of the companies do out there at the beginning of the fiscal year because they weren't planning correctly. Replace that with a pace. and use the speedometer to decide if you're going too fast or too slow.
Man, drop the mic. I think let me summarize here. So the product market fit, we need to retain our customers and understand the value that we are delivering to them. The go-to-market fit really comes to the profitability element, and the growth and the moat really is the speedometer. I love the visualization of it. Obviously, I'm a sales leader, so I'm used to dashboards, but I love the speedometer because the speedometer of all the things on the dashboard is the one that I'm probably most interested in as the person tasked with a quota of growth on the company. The speedometer is the one that we know how value is created in these days, that I'm going to be most focused in. So did I do a good job of
That was
putting those
A
into a box?
plus, Bill.
Okay.
You just got your degree at Harvard. Congratulations. So yeah, and it's cool, Bill, because we're recording this, I think, on January 28th. If you go to my LinkedIn on the date, I just published a post that's very related to this that I'm kind of excited about, and we've used in a lot of companies, which is if you're sub 20 mil, whatever, sub 10 mil, don't be using big company annual fiscal planning. Like big companies have to like start the planning process in August. What's the number next year? Okay, that means we need this many reps. That means we need this many CSMs. We need a finance team. We need to change the comp. I mean, it takes a lot of time to like plan. You have to plan annually. And yet we're a $2 million business, and you set up this annual plan to go from 2 to 6, and then you miss the first quarter by 30%. And the board member's like, hire more reps to catch up. With what? The annual plan. The annual plan's meaningless. Like, okay, I get it. You underwrote the investment with a certain IRR, but no one's selling this business this year. We're in this for 5 years, 8 years, whatever. And when we sell this business in 8 years, no one's going to ask how fast we grew from Q1 to Q2 8 years ago.
Right.
So in startup world, yeah, fine. Set up your annual plan. That's fine. But more importantly, have the conversation with the board and the executive team is like, what are we going to see at the end of Q1 that would cause us to stay on this plan, go faster, or go slower? What are we going to see? And let's reset the plan 4 quarters forward and keep doing that every quarter. Re-ask that question. What will we see after next quarter that says we'll go the same pace, faster, or slower, and reset the plan for 4 quarters going forward? That's startup pacing. And that hits into the growth and moat piece.
I saw the post. Go slow, stay.
It was go sharp. Or slow or stay. That's the decision.
It's a nice, like I am a big frameworks person. I realize that I have a lot of experience from being on quota for a long time and leading sales teams for a long time, but a lot of it's anecdotal. And how do you apply anecdotes to situations? It's harder to do. So that's where I try to always think about things from a foundational or from a framework perspective and bring it. And look, on your annual planning thing, I got to say, here we are, like I said, January 28th. I have some companies that ended fiscal year at the end of December and some that are ending here just this week. And one of the things I'm always kind of a head scratcher on is, your first board meeting of the year, it's probably like 20, 23 days, 25 days after your year ended. And have you seen this where the sales leader gets up and they present the plan, and the plans, doesn't matter what it is, $1 million of ARR for Q1. And my forecast is 620.
Yeah.
And you're like, the ink is still dry or
Dude,
still wet on this plan.
It's insane.
And
all the time.
Yeah.
It's crazy. So, you just have to be doing 4 quarters ahead, for that reason. I mean, we literally had a company, we did a board meeting last week. Company's doing great. Had a little bit of something happened with the churn this quarter. They put the annual plan in front of us, and the churn that has already happened is higher than what they had in the plan for this quarter.
Right. It's like what you just said about should we grow? Should we slow? Should we stay? Right there, you're already telling me that this Q1 we're going to end, and we're going to be in the board meeting 3 months from today and be revising the plan, be adjusting the headcount growth, be adjusting the numbers, which adjusts the spend and the burn profile. So all of those different elements. So Anyways, I just had to react to your last comment
Totally.
there. Mark, this has been a masterclass for,
Thank
I
you,
think,
Bill.
entrepreneurs, for sales leaders together. Like, doesn't matter if you're the founder side, you're the product side, or if you're the go-to-market side. This has been
Yes.
a great conversation all in a nutshell of a little less than an hour. So
Yeah.
I just
I
want
need to
to
capstone one thing, Bill, real quick
hit
before we
me,
leave
hit
with
me.
the readers. Is obviously we're moving into a big unknown territory with AI, with everything, and what go to market looks like. And that's the other use I've seen of the book and frameworks, and why I put it out there is, as Bill's been pointing out, this rips go to market practices down to its first principles. And I do believe that if you use these first principles to build your future AI models, it'll avoid a lot of mistakes. For example, like I think a lot of people are building ICP models based on where demand gen is and where highest close rates are. I think that's brutally broken for the reasons we talked. It should be based on LTV, and that's really what the book does. Is in addition to giving you guidance on how modern systems were built in the last 10 years, I do think there'll be a blueprint for how future models will be built from a first principles up. I just want to throw that in there.
Thanks for landing the plane
Yeah.
for us, Mark. And I'm grateful. Thank you for carving out the time to come do this with me. Really looking forward to the book launch and seeing how that goes. I'm looking forward to seeing the feedback, that not just from this podcast, but from your own content, and then from the book that you get from it. I'm really excited for this.
Awesome. It's an honor, Bill. Thanks for the platform, and we'll see you soon.
All right, take care.